Hi, this is Ron Janish. What we're going to do is we're going to take a look at a technique that helps you identify intraday moves. But we're not just looking at intraday moves, we're looking at intraday moves within the daily moves. So we really would like to have them both agree. Okay, and I'll show you how that works. And there's a number of reasons for that. Because if you, the theory is simply that if you're going with the direction the daily is more than likely to take on the intraday, then you're likely to have more movement in your favor and lower risk. We want to keep the risk down to a couple $300 per contract. Okay. All right. So here's what we're going to do. We're going to take a look at lower risk using multiple time frame trading. Real easy. And to understand, and then you might want to review the golden pivot rule. If you don't, not a big deal. But what's probably, you all know the 3 and 4 setup method, and then right after that you have your initial trend reversal line. Real simple. It's usually a dark line, and then you always draw your final projected area line, which is always drawn as a red line. And we draw it as red because once prices go past there, red, it's stop trading. That's it, you stop. Okay. And then we have what we know is we know that after the trend reversal, we can, on the daily, we can usually find a very tight entry using a smaller time frame like 15 minutes, and I'm going to show you. Okay, so where are we? We are here. This is an intraday line. Let's take a look at daily. Okay. Okay, here we are. So first of all, what happens is you're looking at this much data, right? And with this much data here, you can, even with this much data, you can draw this line and know that if you get a break past this line, that you've got a pretty good probability of the trend continuing. Right? And if you, in addition to the simple straightforward setup that I use, if you want to add median lines to that or other things that you may have, you're welcome to. Okay. So prices go past here. Now once they go past here, what you're looking at is where's the target line. So you draw the red line, and your target line is up here. Now the benefit of having one of these kind of target lines is, rather than a line that just goes across, is that if the move is incredibly fast, you take advantage of that. If it's very, very slow, then it takes a lot longer, but it's at a much lower value. So it works out nicely. So, okay, so let's say on the daily, this thing went long, and way up here is the target line somewhere, and this is the beginning of July. Let's say right now is the beginning of July. Right after 4th of July, you just had a little pullback. Here we are. And prices are kind of bopping around in here. Okay, so let's take a look. If we look at our intraday price pattern, the same thing, no different, of what we did with the daily, we can do with our intraday charts. Really nice. Let's take a look. Remember, this was the beginning of July, because in July the trend was up. Okay, and there we go. Okay, so here we are. It's beginning of July. Here's the 3rd of July. Here's the 4th. Everybody's having a good old time. And so what happens is prices just, going up and down a little violently here on the 15-minute. And you come in over here, and over here you have just the same pattern, same setup as you had on the daily. And so you draw your initial line here, and a break beyond this initial line signifies that the intraday trend is likely to continue, because your daily trend is already up, even though it's this crazy chop stuff, right? And you're looking for something reasonably safe, reasonable with a low enough risk point. And you look over here, and you know, if somebody gets in, let's say over here, this is 1628, your risk is prices spending some time below here, which is 1626. That's less than a couple of $100. So you don't have horrendous risk. And where's your target on the intraday? Remember, you're not using that way out there in the stratosphere target that's on the daily. You're using this on the smaller time scale, so your target is up here. Okay, and your target, it finally goes past the target when it reaches about 1636. So it goes from here to here, and it does so rather quickly. Now, one of the things is that you're going to find, so it seems a little frustrating, but it's not necessarily that bad. What happens is after a nice quick up move, it tends to go sideways and then goes up again and then charges through the line. It's not unusual for prices to charge up towards the line and just absolutely stop and go sideways for a while, just like they did here, and then they go past the line and make new highs. Once they're past the red line, make new highs. Time to stop. Stop trading, out of the trade. That's it, right? Then you're looking for a new setup. And so you have a new setup over here, and once again, boom, away she goes. And so even if you got in here, let's say at that closing price of 1635, and your risk is down to here, 1631, that's less than a couple $100, right? So it's not a horrendous risk point. And where's your next target line? Let's take a look. It's out here. Notice once again, prices shot up to the target line and just stalled and did their little sideways thing. And so what? Does that for a while. You got to have the patience, and it will go past here again, and it goes past there again. Okay, and then sometimes it just keeps on going, and that's okay. All you do is look for another setup. When you have the setup, you draw your lines, and there you are. So this is how you combine the intraday with the daily. Very simple, very straightforward, very Andrews. Andrews doesn't like super complicated stuff. Okay? So there we have it. This is all part of the Advanced Andrews course. This is combining the intraday with the daily. All right? Thank you for your time. See you at the seminar.